Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the Market Site studio, we have Michael Sokoll on Nasdaq's Market Intelligence Desk. We'll also have Brian Joyce on Nasdaq's Market Intelligence Desk joining us for a technical read on the charts. Michael, it's great to have you with us as always. Welcome back to Trade Talks. Really, the crux of this conversation is small versus large cap, and how we saw at the beginning of the year small doing well. Then we kind of shifted into this March rate cut off the table, higher interest rates for longer, and we've seen that switch because we know how higher rates impact the small cap space.
Yeah, and it's interesting that once the odds of the rate hike started to lessen, that's when smaller caps started underperforming again. And this year is sort of like back to the future, those first 10 months of last year where they were underperforming. I think really for the market, Friday's payrolls number was like a big deal. And you saw it immediately in the odds of the rate cut. You saw it immediately in the 10-year, for example. And the S&P and stocks, not so much. They took a little while to understand where they want to go with this. And the question is, are we good versus good is bad, all of that. So the S&P is slow but sure throughout the day, a lot of that being Meta's earnings. But if you look at the last week, Russell 2000 flat, Russell microcaps are down. So the market's still trying to figure out where to go with this. And if you're a small cap, you're not participating as much as the large cap.
I think part of the challenge with the small caps and micro caps, of course, it's always going to come down to balance sheet. Even if we do get a rate cut, whether it's 25 basis points, 50 basis points, yes, cost of capital goes down, but you also need to have the fundamentals behind it as well in terms of good earnings, good guidance, a strong balance sheet. There's a reason why they're not participating outside of interest rates.
There's a little bit of an undercurrent of risk off if you're outside those really, really big stocks. And very much to your point, people wonder about, what rates a company's going to use to refinance themselves. And that's a big issue for those companies.
Yeah, and not to go too much off track here, but even think about fiscal debt, right? There's a lot of debt that's coming due, not just on the corporate side, but also on the fiscal side as well. So the rates, even though inflation is somewhat going down on its own, I still think, whether it's government money or corporate money, they're really waiting for some type of rate cut because capital is expensive.
Yeah, and so you're right. So your discount rate on all those earning streams are lower. And people also now have to a lesser degree than they did a couple of months ago, but they still have alternatives now because rates on zero. They can be in something that's safe and not have to take a risk of being in the market in smaller cap stocks.
All right, let's bring in Brian for a moment here. Brian Joyce, our resident technical analyst on the Market Intelligence Desk. Brian, let's pull up a couple charts here. Small versus large, clearly the narrative for this conversation. What are you seeing in terms of technical trends?
Sorry about that. I think I started off on mute. But if you can hear me, I was saying that if we want to compare small versus large, on a chart here, we want to, simply make a ratio. So looking at the Russell 2000 as a ratio over the S&P 500, we could see it's been in a multi-year downtrend. We did have a little bit of a recovery here back in the end of 23, but ever since, really when the futures on the probability of a rate hike peaked back in late December, that's when we've seen this ratio peaked as well. So here we're looking at, let me flip over to a line chart of the probability of a rate cut in March, and it peaked in December at 90% and has since been in a sharp downtrend. Now it's around about 21%. Earlier this week it was about 16, 17%. And so that move basically peaked, coincided with the peak in the Russell 2000 versus the S&P 500 on a relative basis. And again, just zooming back, we can see it's really been a multi-year downtrend, in favor of large cap over small. Now that's on a relative basis. Here's the Russell 2000, the weekly period chart. We could see that, into year end, we did have that, brief breakout above a, 18-month sideways consolidation range. And then we pulled back over the first 4 weeks or so in 2024. So to me, this still looks relatively constructive. You could say this is a bit of a bull flag here on the breakout. Just needed more time to consolidate, given those strong gains over the last 9 weeks of the year. I like this week's candlestick. We've certainly come off the lows. Keep an eye on the small cap community banks and regional banks. They're, the financials in general are the third biggest weighting in this space. Regional banks last week, with an announcement from one of the New York small community banks, really impacted the entire space. And so that group was down about 13% in less than five trading sessions starting last Wednesday. So I would keep an eye on this. I do like the look of the KRX regional bank index on a very short-term basis. The look from yesterday's candlestick looked like a potential bottoming pattern, but certainly a very, very short-term time frame, so I wouldn't put too much into that.
All right, and Brian, let's take a look at the Nasdaq 100 as well as the semiconductor space. Certainly having a great run here, as Michael had mentioned before, particularly if you're a semiconductor with exposure to NVIDIA, of course. It almost reminds me of tech companies, Michael, that had exposure to Apple. It really kind of put you in that marquee space. So let's take a look at the Nasdaq 100 more holistically, and then also what you're seeing in semis.
Absolutely. So this index, we're looking here at a weekly period chart. If I zoom out over a long period of time, you could see very constructive longer term setup here, where we had a multi-year rise going into the highs of late 21, early 22. This big cup-like pattern, and then a bit of in the middle summer to fall of 2023, this large handle kind of shape right here. Somehow those just disappeared, but now we've had the breakout above that over the last month or so, and this has been taking place here. So this is a move to new all-time highs here, a very bullish constructive setup. The handle is a little bit lower than these prior highs, which sometimes happens. They call it a high handle or low handle. In this case, the latter, the low. This is the semiconductor index, and this to me, is really just the poster child of what we've been seeing in the long term as well as the very near term. And so 2 weeks ago, this to me was this very concerning reversal pattern on the weekly period setup. And I was, of the expectation, my bias was certainly that this is maybe showing some exhaustion signals. There's a lot of bearish divergences out there between momentum, between the breadth. Seeing a lot of people highlight that, but price is really what's most important, obviously. And you can see last week, shook off that, the prior week's, topping pattern, and we were up higher last week. And then look at this move this week as well. So, that's something what you see in bull markets. And so you don't want to get too bearish or too cautious, even if you're a short-term trader, on just looking at traditional reversal patterns and things like that. You certainly want to be rigorous with your risk management system. But overall, what we saw this week and last week in semiconductors, blowing through the prior week's topping pattern, to me, just the poster child, beautiful example of this bull market that we've been in for quite some time now.
All right, Brian, appreciate the technical expertise as always. We'll catch up with you soon. Thanks for joining us on Trade Talks. Michael, to wrap up here, we kind of got over the earnings hump, right? We're kind of on the decline now in terms of the amount of earnings reports that are coming out. Once we get past that, do you think the market is going to revert back to being hyper-focused on what's happening with rates and inflation? It was kind of a nice break to have fundamentals to focus on for a bit.
I think the big number is the CPI. That's the big one coming out next week. I think year over the year they're looking for 2.9%, and month over month it's 0.2%. That's, I think, the big focus, and I think you still have a focus on the inflation. Even though earnings is coming out, I mean, that's what really is about the narrative. On top of what Brian is saying, the S&P's bumping up against 5,000. So even though it feels toppy, you don't want to not be in the market, even if you think the valuations are stretched and earnings might not be right there yet, at least based on Q4, to support that.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.